What if I told you the stock that just crashed 13% in a single day is actually setting up for one of the most explosive moves of the entire summer? Most people saw the headlines, saw the lawsuit, saw the chart breakdown, and they ran. But here on Kalvan Mateo, we don't follow the crowd, we follow the money. And right now, the money is telling a very different story than what the mainstream financial media wants you to believe. Today we're breaking down why HIMS and HERS Health might be the most dangerously mispriced stock on the market right now, what everyone is completely missing about its setup heading into August, and why nearly a third of the float being shorted could be the exact ingredient needed for a face-ripping rally. If this kind of deep analysis is what you come to YouTube for, do me a quick favor, tap that like button and subscribe so you never miss a breakdown like this. Now let me paint the full picture for you, because this is what we call a structural powder keg. Right now, HIMS is not trading on its actual business value. It is trading on pure emotion and extreme value compression. We have a highly unusual scenario where completely conflicting fundamental catalysts are colliding at the exact same time. On one side, you have terrifying regulatory headlines that make the stock look untouchable. On the other side, you have massive global expansion moves that would normally send a growth stock soaring. But the real secret here, the gasoline poured on this fire, is the astronomical 31.82% short interest. Nearly a third of all tradable shares are currently betting against this company. Now ask yourself this: what happens if the underlying business is actually thriving and those short sellers are locked in a very dangerous room with the walls closing in? Here is where the story starts to get more complicated, because the timeline of this collapse was incredibly violent. Just a few weeks ago, HIMS was comfortably trading in the mid-30s, but a rapid succession of market shocks triggered a brutal sell-off. The stock went into freefall, eventually bottoming out at a critical psychological and technical support level of exactly $24.24 on July 30th. But pay very close attention to what happened the moment it hit that price. It did not keep bleeding. Instead, buyers stepped in with immense volume, forcing an aggressive 8.16% recovery rally to close the day at $27.04. That is a classic capitulation bounce. It signals that the market believes the sell-off was deeply overextended and that real demand exists at these levels. But before you get too bullish, there is another layer to this panic that we absolutely have to unpack. To understand why the market is so deeply conflicted on this name, we need to map out the full catalyst matrix. The headwinds are loud and regulatory. An FDA advisory panel caused massive volatility by backing key peptides, but analysts warned the formal approval process could take up to a year. On top of that, a completely unforeseen FTC privacy lawsuit hit the wire on July 29th. Those are real concerns, but silently fighting against those headwinds are massive, tangible tailwinds that almost nobody is talking about. HIMS just finalized a $1.15 billion buyout of Eucalyptus, securing instant global expansion into new markets. They also upsized a 0% debt raise to $350 million to fund a massive artificial intelligence infrastructure push. The market is entirely fixated on the headwinds, while completely ignoring the sheer scale of the growth engine being built underneath. Now let us address the elephant in the room, because this next event is what triggered the real panic. On July 29th, the ultimate black swan event landed. The United States Federal Trade Commission, alongside Utah and Los Angeles County, sued HIMS and HERS. They alleged the company shared sensitive health data with advertisers like Meta and Snap without consent and used deceptive cancellation practices. This single headline triggered a vicious 12 to 13% drop in one session. However, HIMS management has aggressively fired back. They officially labeled the claims as completely baseless, stating that the FTC willfully ignored substantial evidence the company provided over a comprehensive 3-year inquiry. Now, whether the FTC has a real case or not remains to be seen, but the uncertainty alone is exactly what drove the stock into the ground. And if that uncertainty resolves favorably, what happens to all those shorts? And if the legal trouble was not enough, they are also fighting a brutal war on the pricing front. The GLP-1 weight loss market is the new gold rush, and the competition is absolutely ruthless. HIMS is currently pivoting aggressively toward branded GLP-1 medications, taking on substantial restructuring costs in the process. Meanwhile, their direct rival Ro just launched predatory subscription price cuts of up to 50%. And lingering in the background is the retail apex predator, Amazon Pharmacy, which recently introduced a $29 on-demand telehealth option. At first glance, this looks like HIMS is being cornered from every direction, but analysts note a key caveat. Amazon's service is primarily limited to prescription renewals, somewhat muting the immediate threat to the sticky recurring subscription model that HIMS has built its entire business around. Which brings us to the actual numbers. If the business is truly dying, the balance sheet would show it, but it does not. If we strip away all the headlines and look purely at the first quarter fundamental snapshot, a very different picture emerges. The company generated $608.1 million in revenue, continuing its impressive year-over-year growth trajectory. More impressively, they command a massive 65% gross margin, demonstrating elite pricing power even after taking a temporary hit from one-time restructuring charges. They also boast an incredibly loyal base of nearly 2.6 million active subscribers. Yes, they posted a loss of 40 cents per share, but that was heavily skewed by strategic one-time investments in future growth. This is not the fundamental profile of a collapsing company. This is the profile of a growth engine investing heavily in its own future. And when we look at how the professionals are valuing this cash flow, the divide is absolutely stunning. Wall Street is completely fractured on how to price this stock. The consensus average hovers right around $30.15. On the bearish side, you have firms like Truist issuing a $23 price target, heavily weighing those FTC and FDA regulatory concerns. But the bullish side of the spectrum is highly aggressive. Bank of America sees it at $37, Barclays has it at $39, and Canaccord Genuity has planted a flag with a $40 price target. This massive variance tells you one critical thing. The stock is severely mispriced in one direction or the other, and the current $27 level offers an extreme discount to the bullish consensus. Could the bears be right? Sure, but what if they are catastrophically wrong? But talk is cheap. To see who really believes in the company, we have to follow the money. Institutional flows right now are fiercely polarized. We are witnessing a massive tug of war. On the outflow side, Capital World investors fully liquidated a 14.3 million share position, and Goldman Sachs dumped over 76% of its holdings. That looks terrifying on the surface, but look at who is buying the fear. BlackRock, one of the smartest institutional whales in the entire market, just increased its total stake to a massive 11.9%, now holding over 26.4 million shares. Morgan Stanley also aggressively increased their position by 126%. When you see institutions of this caliber actively buying into a 13% collapse, they are making a very clear bet that the panic is entirely overblown. And that institutional confidence is mirrored perfectly by the people who know the company's financials better than anyone on the planet. Insider trading data gives us the final clue to the puzzle. We did see the CFO, Oluyemi Okupe, sell roughly $229,000 worth of shares ahead of the FDA meeting, but that minor sale is completely overshadowed by a massive insider purchase. Board member David Wells, who is notably the former CFO of Netflix, stepped in and bought 48,400 shares. He deployed roughly $1.17 million of his own money at an average price of $24.23. When a financial veteran of that caliber drops over $1 million at the exact bottom of a panic sell-off, it is a glaring signal of deep internal conviction in the company's discounted valuation. Would you bet $1 million of your own money on a company you thought was going under? So how do we actually trade this conviction? Let us break down the mechanics on the chart. Technically speaking, the chart suffered severe damage. The stock broke hard through its structural flag support at $34 earlier in July, crashing violently below both its 50-day and 200-day moving averages. The 200-day currently sits up near $31.20. But the most important technical development is what happened at the absolute bottom. The stock hit $24.24 and experienced a critical reversal. This bounce established a firm psychological floor, proving that there is massive demand waiting in the mid-20s to absorb any further headline panic. That floor is now defended by both institutional buyers and insider capital. And that floor is a nightmare for one specific group of traders. This brings us back to the powder keg. Short interest remains massively elevated at 31.82% of the total float. That is over 61.16 million shares sold short. Here is the critical metric that should make every short seller sweat. The days to cover ratio is currently sitting at 3.23 days. This means if a positive catalyst hits the wire, it would take short sellers over 3 full trading days of average volume just to buy back their shares and escape. They are trapped. The stock is now highly susceptible to a violent mechanical short covering rally where panic buying forces the price up at an exponential rate. Could the shorts be right and the stock goes lower? Technically, yes. But at 31% short interest with a proven demand floor, the asymmetry is massively skewed against them. To see exactly how high that rally could go, we have to look at where the options dealers are positioned. The options chain dictates the battlefield. Right now, there is a massive put wall acting as a concrete floor of support at the $27 and $25 strikes. Market makers will fight tooth and nail to keep the stock above these levels to avoid heavy gamma exposure. Conversely, the heavy call resistance, the ceiling, sits at the $30, $31, and $33 strikes. The current trading zone is caught right in the middle of this gamma friction. If buying pressure can chew through that dense $30 call wall, the dealer hedging will act as an afterburner, accelerating the short squeeze directly toward $33. That mechanical acceleration is what makes these setups so explosive. And that brings us to the one question investors actually care about. What is the catalyst that lights the fuse? We do not have to wait long because a massive binary event is locked in for August 10th. This is the second quarter earnings report. Analysts are currently expecting a 20% sequential revenue jump to roughly $730 million alongside a positive adjusted earnings per share. But the real spark will not just be the top-line revenue. Investors will be laser-focused on the GLP-1 subscriber churn numbers. If management can prove that their pivot to branded medications has not caused mass cancellations and they provide strong forward guidance, shorts will be forced to preemptively cover their positions to avoid total destruction on the other side of earnings. So taking the fundamentals, the short interest, and the options data together, here is exactly how you can approach this setup. Given the deep value compression and the institutional floor established by BlackRock and insider buying, we are looking at an asymmetrical, high-reward long setup heading into earnings. The entry zone sits between $26.50 and $27.15, buying right above that heavy options put wall. The hard stop loss is $24.20. If the stock closes below the recent panic low, the thesis is invalidated and you step aside. But if the powder keg ignites, target 1 is the $30 major call wall. And if we get mechanical short covering, target 2 extends up to $32.40, testing that 200-day moving average. The risk to reward on this setup is what makes it worth paying attention to. Now, before I wrap up, I need to be very clear about something. Nothing in this video constitutes financial advice. I am not a licensed financial advisor. Every investment carries risk, and you should always do your own due diligence and consult with a qualified professional before making any trading or investment decisions. Past performance does not guarantee future results, and you should never risk more than you can afford to lose. With that said, here is my takeaway. What we are looking at with HIMS is a stock where the headline fear has completely disconnected from the underlying business reality. You have BlackRock loading up. You have a Netflix-era CFO betting over $1 million of his own cash at the bottom. You have 31% short interest with a days to cover ratio that traps bears if anything goes right. And you have a massive earnings catalyst in less than 2 weeks. The market is pricing in disaster. But what if the disaster never comes? That is the question worth asking. Now I want to hear from you. Do you think the FTC lawsuit fundamentally changes the long-term trajectory of HIMS, or is this just another short-term headline that gets forgotten in 6 months? Drop your answer in the comments below. If you got value from this breakdown, smash that like button and subscribe to Kalvan Mateo so you are here when we follow up on this trade after earnings. I will see you in the next one.